Swayam Prabha. Digital India. Educated India.
Okay. Uh, Today we are starting with commercial mortgage fundamentals as part of the course Real Estate Finance and Investment Strategies. So, in this course, we have been learning about uh, real estate finance, and in that we have started a discussion on mortgage financing. So, today specifically we will be talking about commercial mortgage financing. So, in this particular class, we will be talking about these learning objectives. So, differentiate between commercial and residential mortgage lending, then identify various types of commercial mortgage products in India, analyze key underwriting criteria used by lenders, calculate essential financial ratios such as LTV, DSCR, debt yield, then evaluate the commercial mortgage approval process and assess current market trends in Indian commercial real estate financing. So, this is the lecture outline. So, introduction to commercial mortgages will be there, then types of commercial mortgage products, underwriting criteria and analysis, financial metrics and calculations, and then market trends and conclusions. So, first, what is commercial mortgage? Now, a commercial mortgage is a loan secured by commercial real estate used to purchase, refinance, or develop income producing properties like, for example, IT parks, malls, or hotels. Unlike residential mortgage, which we learnt in lecture 11, where we saw certain examples. Some examples we deeply studied both in lecture 10, that was about introduction to mortgage financing, and then residence we reinforce some examples. But now here we are talking about commercial mortgage, and commercial loan prioritize properties revenue potential, which is little different. So, key characteristics include a focus on income generation, large loan amount from 5 crores to over 500 crores. So, that is there, and terms are also around 10 to 15 years, and interest rate are between 8.5 to 11.5, that is like if you are talking currently. Now, varying by property and the borrower. So, it will depend on certain circumstances of the borrower or the kind of property we are talking about. So, in lecture 10, we learned mortgage use property as collateral. Here it is commercial property. For example, office in a Gurugram leased to tech firms. Maybe, you know, example would be a developer might borrow 100 crores from SBI to build a Hyderabad mall. So, there are different type of situations like this. Then we go on and talk about differences between commercial versus residential mortgages. So, commercial mortgage focus on the property's income, while residential mortgages, from which we have learned in lecture 11, that it emphasizes the borrower's income and credit worthiness. So, for example, a Mumbai mall loan, lender would check rental income, but for a flat they verify your salary. So, there is a difference. Then LTV ratios are conservative for commercial loans. So, 60 to 75% will be the range versus 75 to 90% for residential, as we had seen in previous lecture. And then interest rates are also in commercial higher in comparison to residential. So, for an instance, ICICI home loan might be 8.5%, but a warehouse loan could be 10%. So terms are shorter, 10 to 15 years up to 30 years. That is the difference between commercial and residential due to market risk involved with commercial, which is higher in comparison to residential loans. Then underwriting is property centric for commercial, analyzing leases versus borrower centric for residential. So there it would be checking CIBIL scores. So documentation is extensive for commercial loans, including rent rolls, and then you would have to ponder that why commercial overall aspects are much conservative or much more restricted in comparison to residential. So the idea here is that commercial property, because it's for business purpose only, and on the other side residential, there are emotions involved, there are family safety involved, much more involvement is there of the borrower. And also for the housing loan, government has a thrust to provide housing to as many people as possible. So the policies are also not that stringent. But for commercial loans, we see that there is a much more stringent application of rules, and much more demands are made by the lending authorities. So then we move to commercial property types in India. So India's commercial real estate includes office properties, retail properties, industrial properties, hospitality properties, and mixed use development. Office properties like IT Park in Bengaluru, Outer Ring Road, are classified as grade A, B, or C based on quality. So we have office properties, in many IT parks. Many times you will see grade A type, B type, or C type, and that is based on the quality of the offices we are talking about. And then we go to retail properties that may include malls, for example, like DLF Promenade in Delhi, high street shops in your own city, or neighborhood centers. And then industrial properties such as warehouses in Chennai, which support e-commerce logistics, hospitality properties cover hotel and resorts, like those in Goa. So mixed use development, basically, as the name suggests, combine all of these: retail, residential, like Mumbai's Worli project. So there are lot of different type of commercial properties there. So earlier we focused on residential properties, but here the focus is income generating assets. So which property would be more inclined for checks, and what kind of checks will be there. So we will be learning about that. So then moving on to classification by lender type. So here you can see that bank holds 60 to 65% market share, with the public sector banks like SBI, PNB, Bank of Baroda, and private banks like HDFC Bank and Axis Bank, offering conservative loans at around 8.5 to 10%. Then we have NBFC, non-banking financial companies like, for example, Piramal Capital, Edelweiss. We have IIFL, Tata Capital, more such type of NBFCs. They have around 20 to 25% market share, and provide flexible terms at higher rates of 10 to 13%. Then we have housing finance companies like LIC Housing Finance. We have which like PNB Housing Finance, and they hold around 10 to 15% and focus on residential adjacent commercial properties. For example, a grade A office in Hyderabad might get 9% loan from SBI, but riskier retail project might use Piramal at 11%. So, in lecture 10, we saw that lenders broadly, like what are the different lenders are there, and here we focus on commercial lending dynamics. And there is a question which arose here, which comes up in mind, and that is why anybody would choose NBFC over a bank. So here the answer would be that consider approval speed, maybe the kind of documents you have with you. Banks would be stringent in their checking, and that may not be the case with NBFC. So there can be multiple reasons, but these are some prominent reasons. Then we move to classification by payment structure. So commercial mortgages vary by payment structure. So fully amortizing mortgage involves regular payment covering both interest and principal, repaying the loan fully over 10 to 15 years with higher payment but lower risk. Partial amortization with balloon payments has lower regular payments and large final payment, often with the 7-year to 15-year amortization. Ideal for appreciating properties like Mumbai offices, so like that. And then we have interest only mortgages, requires only interest payment during the term with principal due at maturity, used for repositioning properties like renovating a Delhi mall. So earlier we saw residential EMI structures. Here balloon and interest only are common due to commercial cash flows. For example, a Bengaluru warehouse might use a balloon loan expecting future rent growth. So that is this classification by payment structure. Then we move to classification by interest rate structure. Here we can see that we have fixed rate mortgages, we have floating rate mortgages, and then hybrid rate mortgages. We understand the basics about them in terms of how they are used for residential real estate, but how they will function for commercial real estate. So that we have to understand. So fixed rate mortgages offer constant rates for 3 to 7 years, shorter than residential's 5 to 15 years, with predictable payments at premium. For example, a 5-year fixed loan for Chennai office might be 9.5%. Floating rate mortgages more common, adjust with MCLR on or RLLR with spread of 0.5 to 2.5%. So an Axis Bank loan might be MCLR plus 1%, around 10%. And hybrid mortgages starts fixed for 3 years, then float balancing stability. So basically some of this we have already understood in the previous session, where we understood in terms of how in residential real estate we can apply this. Then we move on to property specific products. So here we are talking about whether we are going for office building mortgages, or we are going for retail property mortgages, or industrial warehouse mortgages. Now in office we have a LTV of 65 to 75% for grade A properties, which are the most premium in quality terms. Then here focus is basically on tenant quality and lease terms. If we talk about tenant quality here, so tenant quality, depending on the kind of companies who are tenant here. So if there is a very big name associated with the property, it's not just that that property which is being used by them is impacted, but the overall office building gets impacted by that. So it brings much more stability to the rentals of that building. So if any lending institution is looking at it, they will definitely consider that aspect, because so for example, uh, let's say a big recognizable name like Google has office in a particular building, then other companies would definitely be eager to open their office in that particular building. So the importance of building goes up. Then lease terms is also important for any lending institute, because how long period is there for the lease term. So if the leases are for a longer period of time, maybe for 7 years or something like that, then in that case, of course, it brings much more stability to the rental yield and the overall stability of the business. So that is something which banks would definitely look for, and typical MCLR rates will be plus 0.75 to 1.25. Then we have retail property mortgages, where LTV is on the lower side, more conservative. And the emphasis is again on location and anchor tenants. Anchor tenants, again, the same concept which we applied for tenant quality in office building. Here also, it somehow mirrors that. That is the main shop which is opened in a particular mall is the anchor tenant. And for example, like in previous classes also, I gave one example of West Side being open in a particular mall and mall being recognized by that particular store. So, so any lender would also look towards the anchor tenant. And the location of the mall becomes very crucial, because some areas are famous for shopping and more transport friendly. So all that will also be considered. And then higher scrutiny of the tenant mix, that is the kind of mix a particular mall has or a particular retail destination has of different tenants. So that will also play a crucial role here. Then we have industrial warehouse mortgages, and where here growing acceptance due to e-commerce. So there has been a lot of pickup in this area, and that has happened due to the requirement of e-commerce. They are needing more and more warehouses for expanding their operations throughout different parts of India. So that is also growing up, and this sector for lending is picking up. So here LTV is around 60 to 70%, and focus is on specifications and location, of course, that how near it is to a particular office or overall city. So all that is basically considered here also. Then we move to the underwriting framework. So here we see the three pillars of commercial mortgage underwriting. So we talk about property analysis, income analysis, and borrowers analysis. So in property analysis, we can see that physical condition and the quality of the real estate we are talking about, and then the location assessment, where the location of that particular property is, and the market positioning of the property. Then in income analysis, we would be talking about rental income verification, because here we are focusing on commercial real estate. So rental income, it becomes important. So that has to be verified by the lender. Then lease structure. So what kind of lease structure we are talking about, because there can be different type of leases, how the exit of tenant can take place, what are the term and conditions. So all that will become part of this lease structure. And the operating expenses of any particular establishment, say for example a mall, what are the expenses which mall managing company has to bear. So all those things will become part of the income analysis. And then borrower analysis, that is maybe the manager or managing company of a mall, or the owners of office, what are their financial strength, and what is their experience and track record, and guarantors capability also. If there is a guarantor involved, what are their capabilities, how financially stable they are. So all this will be looked under the underwriting framework. Then we have property analysis components. So we have building class, grade A, B or C, and the kind of age and condition we are talking about of that building, how old it is. Then the technical specifications of the building, the different whether building is LEED certified, what is the headroom. So all these, what is the structural frame of that building. So all that will be part of technical specifications. And then we have compliance with safety codes, how safe building is in fire situation, and other such disastrous situation, how well the safety codes have been followed. Then location evaluation. So what is the micro market positioning of that particular commercial real estate. Micro market is basically that in the overall city, that particular area, how well suited it is for that kind of establishment. Some markets, for example, we have high street markets like Khan Market in Delhi. They are especially marquee in comparison to other markets in that area. So micro market positioning. Then transportation accessibility, how easily people can reach there. So if we are talking about retail commercial real estate, then in that case, how easily customers can reach there. Or if it is a office real estate, the workers, how they can, employees of that company can reach office. And the infrastructure quality, which is there in that area. And then future development plans of that area, like what are the possibilities of future development in that area. Maybe there is a road widening project which is about to come, or maybe there is some new flyover which will make access easily. So there are these things which has to be analyzed. And then market context we have of supply demand dynamics. That is of course important, that what is the situation for supply demand, how much is demand for that product a particular commercial real estate is generating. And then comparable property analysis, that is around that area, what are the other such properties and what they are, how well they are working, or how their business is going on. So all that has to be compared. And then the rental trends and projection, which will be there. So on the basis of past records and the current situation, maybe future development plans which we have seen. So we will try to analyze what will be the rent trends and project it, and accordingly decide on the value of a particular commercial real estate. Then coming to income analysis. So we will have rental income verification. So there we have current rent roll analysis. So basically that will be about how much rent currently the tenants are paying. So that will be important point here. Then we have market rent benchmarking. That becomes another point. Then lease expiration schedule. So that is there. And then we have lease expiration schedule. After that we have tenant credit quality, and we have operating expense analysis, property taxes, insurance cost, utility and maintenance, management fees. So these are operating expenses analysis points. So that is how income is basically looked at. For example, a Mumbai office with the IBM as a tenant is stable. Operating expense analysis include property taxes, insurance utility, and management fees. Typically 25 to 40% of gross income. Net operating income or NOI is calculated as effective gross income minus operating expenses. So, a Bangalore mall with 10 crore gross income and 3 crore expenses has 7 crore NOI. This builds on what we have done earlier in lecture 10 on NOI for DSCR. So, now we are focusing on the commercial loans. So, here the question arises is that why tenant credit is crucial, right? So, the answer would be that there is consideration of default risk that has to always be there in the mind of a lender, that what is the possibility of a default, and they will of course keep that in mind when they are analyzing. So, that is why that has to be taken care of. Then we move to borrowers analysis criteria. So, here we are talking about net worth first. Typically, we are saying that it's 1:1 ratio to loan amount. So, that is there, and then we are looking at liquidity, which is around 10 to 15% of the loan amount in liquid assets, and then CIBIL score, of course, that is, it should be preferred above 750. So, then we will go to experience evaluation. Here we will talk about this track record with similar properties. So, the kind of track record we have with similar properties in that area maybe, or something like that. For example, developer seeking 100 crore loan for a Hyderabad hotel needs 100 crore net worth, right? And prior hotel projects they have done. So, that is there. So, that kind of system we will be following here for borrowers analysis criteria. So, net worth, typically whatever they are asking for, their net worth should be around that. CIBIL score above 750 preferable, and in past what type of projects they have done, and what has been the experience of that with the other financial institutions if they had taken loan for that. So, all that will be analyzed. So, previous financing relationships, local market knowledge of that person. So, all that will be established. Then we move to key financial ratio, which we have to look into. So, we talk about loan to value. So, 4 key ratios here: LTV, for loan to value ratio, then debt service coverage ratio, DSCR, debt yield ratio, and then break even occupancy. So, when we are talking about these ratios, we have to remember that these ratios work together to assess loan risk and determine appropriate terms. So, we have introduced this debt service coverage ratio in lecture 10 on the introduction of mortgages. At that time we discussed it. Here DSR is joined by debt yield and break even occupancy, which is unique to commercial loans. For example, HDFC Bank uses these to evaluate a 5 crore loan for example, maybe for Chennai warehouse. So, these ratio balance property value, income and debt coverage, and you can ask here that which ratio might lenders prioritize for a new mall. So, there is a new mall being built. Which ratio might lender prioritize? Will they go for loan to value ratio? Will they go for DSCR, debt yield ratio, break even occupancy? So, the idea here would be that they will look for income stability. So, whatever checks the income stability will be the one which will be looked into. So, then we move to loan to value ratio, and understand its meaning. So, LTV is loan amount divided by property value times 100% times 100. So, commercial LTV are 60 to 70%, 60 to 75%, and they are lower than residential 75 to 90%. We have understood that why that is the case. Office properties get around 65 to 75%. Retail properties get around 60 to 70%, and industrial are there in the range of 60 to 70%. Or hospitality is 50 to 60% due to volatility of that particular area. We have seen that in COVID time, hospitality was extremely impacted, but after that it picked up and picked up amazingly. So, it's a very fluctuating business. So, LTV also is, that is why, on the conservative side. We can see one example here that a 100 crore Mumbai office with the 70 crore loan has 70% LTV. So, it is a straightforward calculation, not very difficult to understand. So, basically that is the case of LTV ratio. Then we have debt service coverage ratio, DSCR. Now, DSCR is net operating income divided by annual debt service. So, measuring debt coverage basically. So, commercial requirements are 1.25 to 1.40 for office properties, and industrial would be 1.30 to 1.45x, and 1.40 to 1.60 for hospitality. So, in residential rental, we had seen that it is 0.45, which is one example we saw, which was unacceptable. Here we have one example. Here we are talking about a Bangalore office with 10 crores NOI and 8 crore debt, and this has DSCR coming at 1.25, which meets the minimum. Below 1.25, lender like SBI may reduce the loan and focus on commercial, threshold. So, that kind of thing is there, that the amount of debt which is there on the annual NOI, that is considered. Now, if that is on the conservative side, bank would definitely would like to lend it, but if it is riskier, that is the amount of debt is very high when we are talking about net operating income, then in that case the lending institutions will of course become more conservative. Also, we can see here that for office properties, it will be 1.25 to 1.4, understanding that they are much more stable business. Whereas in hospitality, they understand that there is a lot of fluctuation, and that is why the ratio we can see is 1.4 to 1.60. So, that kind of understanding of the business has to be there, and that is why you kind of see this type of DSR ratio range. Then we move to debt yield ratio. Now, here we see that net operating income divided by loan amount into 100%. So, we can see that debt yield is net operating income basically divided by the loan amount times 100%, and it's showing income relative to the loan basically. Requirements are 9 to 11% for prime office, 10 to 12% for retail, and industrial around 12 to 10, industrial 10 to 12%, and hospitality 12 to 14%. Again, we can clearly see that the ratio is not universally applied. It is dependent on the kind of business we are talking about, whether it is prime office, retail, industrial, hospitality. So, that consideration is kept in mind. We have one example here. So, say for example, this is a 60 crore loan for a Delhi mall with 9 crore NOI, and it's yielding, debt yield of becomes then at 15%. So, debt yield is um, basically independent of rates, unlike DSCR. And we have not seen this earlier being used. This formula is basically used for commercially focused establishment. For example, NBFC like Piramal Capital or some other such company would prioritize debt yield for volatile markets. And the idea here again, that why it is high for hospitality in comparison to others. So, the answer would be, of course, that there is lot of fluctuation in income in this kind of business. So, that consideration has to be kept in mind. Then we go to break even occupancy. So, break even occupancy is operating expenses plus annual debt service divided by potential gross income times 100%, showing minimum occupancy to cover cost. So, a Hyderabad of warehouse with the 4 crore expenses, 8 crore debt service and 15 crores gross income has 80% break even occupancy. So, properties must maintain this occupancy to avoid default. So, when it is at 80%, then it is break even, right. So, that is the kind of expectation we have this from this business, that when it is at 80%, then it is profitable, that then we can rely on this business. Properties must maintain this occupancy to avoid default. And again, this particular formula which we are seeing here is unique and is used basically only for commercial properties, unlike the previous residential properties where we are using this specifically because it is income related. So, this is used for commercial real estate. Then let us take a practical example here of office building analysis. So, this is a 10,000 square feet property on outer ring road, has in Bangalore, and has a current rent of 75 per square feet per month and 90% occupancy and an 80 crore value, and the gross income is 9 crores. Operating expenses are around 3 crores, that is 33%, and then yielding is of 6 crores NOI, this business, and a proposed 56 crore loan which is 70% LTV, has 5.5, and also this annual debt service we are coming at 5.5 crores. So, DSCR ratio, if we find out, it will be 1.09, below minimum requirements. We can clearly see that annual debt in comparison to gross income is very high. And also, if we calculate the debt yield, it is coming at 10.7%. So, that means that the two ratios are showing two different pictures. So, in this case, then in that case, we will go for the conservative side. Bank will, or any institution will always go towards the conservative side, and because the earlier ratio was showing the lower number. So, what a lender can do is they can reduce the loan to, instead of 56 crore, they can reduce it to 48 to 50 crores, because then they will feel much more safer in comparison to what they are currently you looking at. So, there this kind of situation can arise, that one ratio is pointing something and the other ratio is pointing something. Then in that case, we will of course go towards the conservative side, and that is how the system or the lending will operate. Then we have risk assessment and mitigation. So common risk factors we have is tenant concentration. In some situations, we have this issue of tenant of a specific type concentrating in a office building, and that may not be very good sign. So because if something happens to that set of business and the industry overall gets impacted, and most of the tenants are of the same industry, then that can be a risky factor. Then risk expiration bunching, then that is many leases are coming to expiry together, and that can also lead to drastic fall in income if there is no continuous tenant there. There is a sudden vacancy happening, that can also be riskier. Then if there is newer and more projects coming up in that locality, in that micro market, then that also has to be considered, because there is a market oversupply, and that will put pressure on the future rent negotiation. So that is a risk factor which has to be considered. Then location challenges are of course there, that some locations might get impacted by infrastructure developments and all that. So that is there. Then what kind of risk mitigation strategies we are talking about here? So lower LTV ratios, cash reserves, additional collaterals. So you know lending institution can lower their LTV ratios, the amount of loan they are giving they can reduce. We have just saw that in example previously. They may look for more cash reserves. They may go for additional collateral. They demand that. Enhance the reporting requirements, more reporting if they see some issues, and then interest rate caps can also be there in such situations. And then stress testing can also take place, where it evaluates the vacancies in different scenarios, the rate hikes which can happen, or downturns which can lead. One example we can take here is that SBI might test a Delhi office for 70% occupancy. So they will plan accordingly, and these type of assessments will be done. Then we move to current market landscape. So India's commercial mortgage market we are reviewing, and the total loan book is around 5.2 lakh crore, with 1.5 to 2 lakh crore in annual origination. Mumbai leads this at 20 to 25%, followed by Delhi NCR 20 to 23%, Bangalore after that 16 to 19%, and Hyderabad at around 10 to 12%. Interest rate, if we are talking about, for banks, interest rate is somewhere around 8.5 to 10.5%. Then NBFCs, of course, higher side, that is 10 to 13%. And these are trending stably as per the RBI policy stance. So for example, we can take here that a Bangalore IT park might get a 9.25% loan from HDFC. So you can see that the stability of the business and the kind of mortgages they can give. So that kind of thing is understood. So this is basically how the current market landscape is panning out right now. Then what are the emerging trends we can see? So digital platforms for loan processing, lot of fintech is coming in this area. AI based preliminary underwriting is there. Then blockchain for documentations is taking place for the safety and security of the documents. Then we are talking about green financing. So preferential rates for certified green buildings. So if the building is LEED certified, it becomes easier for it to be financed. There are certain benefits given to such type of buildings. Also it may sound that it is a buzzword, but the sustainable buildings also reduce the overall energy cost of that building, and in long term they can be very advantageous. So that way also the lending institutions are looking at these buildings with much more respect, and they are showing it through the kind of rates which they are offering. Then ESG criteria integration. So many lending institutions are also now thinking about ESG criteria because it is becoming very important world over, and that is being integrated. So the better a particular business integration with ESG is, so that is considered. And there are sustainability linked loans also. So there is this thing which is emerging in the market. Then alternative funding sources are also coming up in this area. So we have discussed briefly earlier about real estate investment trusts, new concept which is coming up, and then we also have alternative investment funds. They are also picking up, and a lot of entry of foreign institutional capital in India, and they definitely are looking at technology integration, green financing. So all these things are happening in market right now, and it is expected that they will accelerate with the time to come. Then coming to regulatory developments. So RBI guidelines govern commercial real estate exposure basically. There are a lot of regulations here. It's not without any regulation that any lending can operate, lending institution can operate. They are under the guidelines of RBI, they are working. Then also RERA implementation has impacted. And then we have foreign direct investment regulations, which are also playing an important role here, because many times these commercial establishments are getting a huge sum of foreign direct investment. So that also has to be regulated, and special provisions are established for the foreign investments. Recent changes, differentiated risk weights by property type. We have seen that the property types under the commercial property itself, that the subgroups are there of office, industrial, and hospitality. So the variation is of course being looked more properly, and accordingly the decisions are made, whether it is, you know, how you are utilizing a ratio also, that is depending on this. And these are coming through regulations. And then standardized valuation methodologies. The valuation discussion which we had earlier, we saw that there are different type of valuation methodologies, and there is a standardized processes which are now there and expected from lending institutions. So many times third party also becomes important. And then impact on the lending. So more stringent documentation, especially when we are talking about commercial real estate, we have to remember this. And then improved transparency, because unlike residential real estate, here there is a higher chance of the kind of malpractices. So in that is the reason that regulators actually have looked into this area, and with their policy position they have tried to improve the transparency in this area. And then better risk management practices are now being developed through various means by regulations in that area. So more and more transparency and better management we are looking at this particular side of the real estate. Now let's take one case study example here. So this is a grade A office building, BKC. It has a size of 200,000 square feet. The occupancy is 85%, and the purchase price is 150 crores. The financing structure is basically 70% if LTV, bank loan would be 105 crores, and interest will be MCLR plus 1%, so that would be 9.25%, and term will be 12 years and 15 years amortization will be there. So that is the period, and so key metrics, DSR will be 1.35x, debt yield is 11.2%, and break even occupancy is 78%. And because all these meeting standards, so all these basically are showing that this is a robust business and it can be lended. So any lender would definitely go for it. So this kind of process we can see here is being used to decide whether a particular commercial establishment has to be given loan or not, and ultimately through this process we have realized that okay, this is showing income stability and we can go for lending. Then we move to key success factors here. So for borrowers, maintaining strong property fundamentals, diversified tenants, quality tenant base, they should have comprehensive documentation available, because that will be of course demanded from a commercial establishment by the banks or the NBFCs, and they should be able to demonstrate operational expertise in that area, that they have been in that particular business for a long time. Then for lenders, through property and market analysis, they should be able to gauge the functions, the businesses of the borrowers properly, and then conservative underwriting assumptions have to be made. If there has to be a mistake, it has to be on the positive side that we have discussed earlier, and then appropriate risk pricing, continuous portfolio monitoring. These are two other steps which banks or lending authorities should definitely look into. And then market development, increase institutionalization is something which is gradually happening. More and more technology adoption, new technologies are coming and they are being quickly adopted. And then regulatory compliances are of course there, that more and more stringent regulations which are stringent for improvement of the business, transparency of the business are coming in. Then what are the future outlooks here? So possible market growth of around 12 to 15% CAGR. Then increased foreign participation is expected. Technological driven efficiency will bring out more gains, and product innovation and customization. So new and newer mortgage products will be introduced, which are there in the developed worlds, will be also brought in here in India, and they will be of course customized to the conditions which are in India. And then there are certain challenges also, that we have interest rate volatility that has to be seen, and then there are certain amount of regulatory complexities. This has to be streamlined and has to be much more simplified. Then market cyclicality, that also is a challenge in this area, that sometimes we have very good business environment and sometimes it is not. And then competition intensity is also picking up, because the kind of possibilities which are there in India are immense. So of course there will be competition in such areas. And then opportunity infrastructure development is there, urbanization trends. These are something which are shot in the arm for any business. And then corporate expansion, ESG integrations, they will also be something to look forward to. Then what are the key takeaways? Property income is the most important yardstick for commercial mortgages. Key ratios we have seen, whether LTV, DSCR, debt yield. Then conservative approach has to be maintained by the lender. Market specificity, different property types has to be taken care, into consideration. and relationship matters between strong borrower lender relationship has to be there, and documentation is critical. So proper documentation has to be maintained by the borrower. Practical applications, when to consider commercial mortgage. So property acquisition financing, refinancing existing debt, cash out for other investment, development project funding. So all that has to be there. Selection criteria, compare multiple lender options. This is from the borrower. Evaluate total cost of the capital, consider prepayment flexibility, and assess reporting requirements. And then best practices, start processing. All that has to be done in the right time. Questions, these are some questions for self-assessment. I hope you will think about it. These are the resources which you can go through. Thank you so much.